Welcome back to the Canadian Real Estate Channel. I'm Adam JD Martin, your host, and today I've got Cody Yeh here for another fireside chat. We're talking stocks, we're talking options, and most importantly, we're talking the set it and done strategy, amongst other things. So Cody, get us started, man. What are we talking about today?
Yeah, so today, continuing on our last video where I talk about my story, how I was able to retire from my full-time job and put up my real estate portfolio to $5 million and also grow my stock account from $500,000 to 1.6 million since 2019. Today, we're really going to get into the nitty and gritty and show how real estate investor, if they're struggling with generating cash flow, if they're struggling with finding their next deal, do they really need to force themselves into buying more real estate, or do they really have to sit on the sideline until the interest rate drop, right? And also talk about the capital gain inclusion rate has increased in Canada and how we can actually capitalize this, turn the lemon into lemonade by setting up a corporation correctly. Again, I'm not an accountant. I just want to share my structure if people stay until the end, right? And all that stuff. People who are at that level have a few properties, want to scale up. They might want to diversify their real estate portfolio into the stock option investing and, strategy, because 87% of my clients are real estate investors. So yeah, hope I'll bring a lot of value for you guys.
Yeah, that's awesome. And I know that with the interest rates, the way that they've been and sort of some of the uncertainty, especially with how prices have fallen over the past few years, like both that boom and then the bust cycle, plus the interest rates, American election coming up, Canadian elections on the way. It looks like there's been a lot of uncertainty in the real estate market, and it's been particularly hard to make clear, easy, simple profits for the last couple of years. So I know people at home watching are looking for different strategies on how to diversify, how to spread out some risk, and how essentially that they can continue to make money without necessarily having to, go all in on a real estate market that they don't really trust as much anymore. So I'm glad to have you here and talk about some alternative strategies and really uncover what people who are already real estate investing can do with some of their extra capital if they have the opportunity. So let's dive right in, man.
Yeah, let's go right into it. So the first slides I'm going to show is it's from Canada.ca. It's a tax fairness for every generation, the article that came out April 2024, right? So I'm just going to read it out quickly in case people are not listening or watching the screen, right? Individuals will continue to only pay taxes on 50% of any capital gains up to $250,000 per year. And inclusion will also increase to 2/3 for all capital gains realized by corporation and trusts, right? The new rules will take place June 25th, 2024. Again, it might be updated already. This is not the whole picture, but all we know is that going into the future, if you have more equity in your property, right? Traditionally, real estate investor has been utilizing the refinancing route, right? I know a lot of residential real estate investor are getting caught on the part where the rent did not go up that much. Even though they have a lot of equity appreciation, they cannot pull the equity out because the banks just will not give them that much more because of loan to value, or just because of their income of DSCR is not supporting it, right? So that's why a lot of people try to go into multifamily, and I personally try to go into multifamily. A few deals fell through and we're really forcing and not seeing a lot of deals. So that's why I think our set and done strategy has been really, really helping a lot of investors, helping them generate more cash flow, consistent cash flow, and helping them continue to scale up, right? Their own account to buy more properties and not have to raise capital and go into that joint venture with syndication route, right?
Yeah, that's great. I love that you used the word consistency there. And I know that's something a lot of the people that watch our channel are interested in because for the most part, like real estate investing should be boring. It should be consistent. You should have predictable results. You should be able to do the strategic renovations that you set out to do and make a predictable return almost every time within a margin of error. So it's good to hear that this strategy also involves consistency because I know that's exactly what people here want to hear. So Yeah, let's go in. I want to see how you make $4,500 additional per month.
Yeah, so, like just a disclaimer, right? This is based on our track record, my own track record, or our students' track record with their account over $100,000, right? That's where we can look at the return and make additional $4,500. You want to have an account over $100,000. Can you start with a smaller account? Yes, you can. But for your time to make sense to learn this, eventually only spend 30 minutes per week, you really want to and continue to scale up your account to make your time worth it, right? So what are we going to talk about in the next little bit is why is this important to you? We can already lay that out, right? Who's Cody Yeh? Why am I talking about this? Who's this young Asian guy, 33 years old, talking about this kind of stuff? Why should we trust him, right? And why I think you should consider our strategy, right? Because most of the audience on your channel are real estate investors. So I've been talking and having a lot of clients are real estate investors. So I'll be using the terminology that we can relate, which is buying off-market deals. In this case, we buy off-market stocks, right? And then some people, fewer people might know this term. It's called rent to own. It's another strategy in real estate where you can get consistent cash flow and promising to sell your property down the road, for appreciation. Then that's the term we could use introducing our said and done strategy as well, right? And after that, we're going to go into our back testing, right? So a lot of time people ask, Cody, how long have you been using this strategy? What is the results look like, right? So I have my own results. I share on my YouTube channel if people want to go, right, for a full year and starting from this amount every month, go boom, 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 right? That's 36% per year. But then I back tested for the last 10 years. Again, I can't go into the future, so I go to the past for 10 years. And you guys will be seeing those results. So stay tuned. So like I said earlier, if you guys want to know how I set up my corporation, I'm not an accountant, but unfortunately, Canadians have a lot less selection comparing to US in terms of their tax segregation, cost segregation, offsetting their income. But this is what I've been using. What I talk to a lot of 7 to 8 figure investor, business owner have been using this structure. So personally, I've been using this. So if you guys want to know, stay until that part. And of course, I'll show you guys the next step on how you guys can learn more, and my team can just guide you guys for that as well.
That sounds fantastic. I'm definitely ready to learn.
Okay, let's go. So about Cody Yeh, right? I was speaking to a lot of real estate investors, and also we have helped over 6,307 real estate investors make an additional cash flow each month using our said and done stock option investing strategy. Again, everyone start at different places, has different risk and reward appetite. Some people start at 30K, some people start at 50K, some people start at 100K, some people start at 300K. One of my VIP clients started at $1 million, right? So everyone's different, but we help them at different level. And the ultimate goal is that you continue to scale up your account. So your time that you put in to learn, and ultimately only put in 30 minutes per week without dealing with tenants, toilets, contractors, and all the good stuff that real estate investors really like. You don't have to deal with that. It's just your phone, right? And then 30 minutes per week, you can do it anywhere in the world. So, I was invested as a guest speaker for a TD Bank 3 times now, 1 time each year to talk about our strategy and our improvements. So if you guys want to learn more about it, you can DM me or just go on TD Bank YouTube channel, type in Cody Yeh, you will see it there as well. So just for you guys know, I'm not just a smoke show, don't know what I'm talking about. Like big banks runs really tight compliance. They go through almost all my emails to make sure I'm compliant and all that good stuff. Now, we're going to take a little pause here because this is a very important step, right? We're going to pause for 1 minute, right? If you're watching this video and if you want to just pause your video like for 1 minute and come back, that's no problem, right? I want you guys to take a piece of paper and write down the true reason why it's so important to earn additional cash flow per month. Most of my clients, right, high income earners, 7 to 6, 7, 8 figure net worth, right? To them might not be really replacing the full-time job, but it's about diversifying their portfolio, real estate portfolio. They want to continue to scale, but right now they feel kind of stuck. There's a lot of debt money, right? So I really want you guys to write down the true reason why are you guys on this video learning something other than real estate investing, which is stock option investing, right? Most people only have stock investing, maybe some mutual fund, ETF, but now is a stock option investing. Why are you guys here? And why is that additional cash flow so important to you guys, right? Is that for generational wealth, or is that for just safety net, or is that just for scaling? Whatever that is for you, pause your video when you guys write it down. The most important one that's keeping up at night or waking up in the morning every day that kept you going, then write it down, right? And then once you guys are ready, we're going to go again.
Yeah, I would say goal setting is one of the most important things that people like gloss over. And this is a really important step to understanding any financial tool or investment or instrument and really setting your business off right. I think goal setting is really important to help you clarify and prioritize what you actually need to be doing. It can help motivate and inspire you. It helps you obviously measure progress. Like it's very hard to tell if you're going in the right direction if you don't know what progress looks like. Obviously, it can help you with personal and professional growth. So I think that's really important. It also helps you to gain resilience, right? So when a strategy is not going exactly how you wanted, this type of activity can help you to stay on track and keep your resolve throughout that process. Because generally speaking, and I don't know a whole lot about this strategy, we're going to keep learning, but generally speaking, there's ups and downs with literally any strategy and anything you do in life, right? Think about the day that you're having today. It's either a fantastic day, the best one you're having all week, or this might be the worst day of the week so far. And you really just need to understand that if you understand where you're going longer term, you can see that a bad day, whether that's economically or how you feel that day emotionally, like that's not really an indication of where you're going in the long term. So take activities like this very seriously and just realize that your goals need to be more than money, and they should really identify your why to a deep core. So yeah, thanks for including that, Cody. And I think it's a really important activity to focus on.
Thanks for emphasizing that again. And once we have the why, we can go into the how, right? And then we can go into the how, right? And the first concept that I could promise introducing it in the real estate term is, right, Adam, you're a real estate investor, right? Whenever you heard about buying off market deals, what's the first thing that comes to your mind?
Yeah, I mean, buying off-market deals. Obviously, I built one of the largest businesses in Canada that did that. And when I think about off-market, I think there's more opportunity for creativity. There is often price discounts. There are often different sort of terms that you could achieve that are maybe not possible under traditional routes because of social norms and things like that. So yeah, I mean, generally speaking, when I hear off market, I think creativity, or I think flexibility might be the best term.
Yeah, creatability, flexibility, and a lot of time is less eyeballs on the deal, so you can get a discount. That's a lot of time below the market value, right? Without the bidding wars and all that, right? So in our case, in our strategy, how do we do that to buy off-market stocks? Is that we sell put options. Okay, selling put options. So for a lot of people never heard about it, just stick along. I'm going to give you guys a real example in 2 slides from now, but just sticking along, right? Usually in the wholesaling deal, right? There's a lot of wholesalers in the industry, right? When you buy a deal from a wholesaler, do you usually pay a fee, Adam, or do you get pay a fee?
Yeah, if you're like when we're buying, we're paying a fee to purchase
Yeah,
a wholesale deal, and obviously, if you're selling, you can sometimes get that deal.
yeah. So imagine, we can buy a off-market deal and we're getting paid to do so. We're getting paid instead of paying for the wholesaling deal. So that's the first thing. To me, is it's a double win, right? And also, I talk about why investors like wholesaling deals because creative creativity, flexibility, and then the ability to get a better deal at a cheaper price, right? So who doesn't like to buy stuff at a cheaper price, right? Who wants to get paid as a wholesaler? In this case, we are kind of like the insurance broker because as wholesaler, we get to pay, you get paid a fee. But in this case, we are basically agreeing to buy a stock we want to buy anyway at a cheaper price, right? So it's kind of like, imagine an example of, if my neighbor wants to sell their, well, okay, if my neighbor, Grandpa John, is afraid that their property can go down in price because of this high interest rate, no one's making money, inflation is high, right? His house right now is worth $500,000, but I think he thinks it will drop by 20%, right? So here I am, go on to Grandpa John and say, Grandpa John, what if I agree to buy your property? If they drop more than 10%, I will buy it at right at 10%, which is $450,000, right? So basically, Grandpa John will be able to alleviate his risk, thinking that it would drop more than 20% in 1 year. But then we come in and say, if it dropped more than 10%, we'll buy at $450,000. But then if you keep dropping, you don't worry about it. You lock in at 450,000. But then for us is that if next year that comes in, right, and then we have three appraisers appraise the property. If it's lower than $450,000, we have to buy at $450,000. Whether the property right now is at 400, 350, and whatever. But as an investor, we already know what to do with the property. We know we're going to do some renovation. We know our numbers, right? Because we own the property right across the street, right? So, that's our way of buying off-market deals. And we can do that every day in the stock market where we're buying off-market stocks. Okay. And a lot of people might be questioning, is like, Cody, so what's a catch, right? So you will agree to buy Grandpa John's property for, if it's, it dropped more than 10%, if it dropped 20%, you still buy at 10% off. What's a catch, right? And the catch, I wouldn't say is really a catch. It's kind of like Papa John buys an insurance contract, right? Buys an insurance contract to pay us $10,000. So he pays $10,000 to hedge the $50,000, and anything lower than that, he only loses the maximum $50,000. So that's Papa John, and we're on the other side. We get paid the $10,000. We agree to buy the property you want to buy anyway at 10% off. If next year comes, three appraisals come in, everything's above 450, whether it's $500,000, 550, 600. We walk away with the $10,000 premium. We walk away with it. We don't have to return, and that's our cash flow. In worst case, it dropped. We already know what to do. We're holding the real estate for long term. We're holding the stock for long term. We know what to do. Then, we're basically getting some equity already built in, and we're getting paid a cash flow for doing that. Does that kind of make sense for you, Adam?
Yeah, that definitely makes sense to me. So essentially, he's trying to minimize his risk, and we are willing to accept the risk based on our analysis of the market. So we don't believe, so essentially he believes there's a greater risk than we do. And we think that because we have other information, or we've done more research, or we have a better idea of where it's going. And so he's essentially buying insurance from us. Is that kind of sum it up?
Yes. He's buying the insurance from us, and we're the insurance company, and we're ready to take over the property if required. But
Yeah.
most of the time we don't have to, and we're getting paid to have the obligation to take over the property we want to own anyway at a cheaper price now, right? With the premium getting paid on top.
Right. Yeah, that totally makes sense. So I guess my first natural question there is, how do I have a competitive advantage or comparative advantage in terms of information over John? Right? So like, why am I more certain that it's not going to drop the 10% than he is?
Yeah. And what's the interesting thing, Adam? I think we chat about this offline. Most of the people like Papa John, it's not like they don't know what they're doing. It's because all these big banks and hedge funds are holding a lot of investors' money. So they are being rewarded not by beating the market index. You're getting rewarded by having less volatility. So when the market make 10%, the investor is okay with them making 5 to 7%. But when the market drop by 20%, if they come out and say, I only drop by 10%, they seem like a hero. And that's the norm. I know it doesn't make sense, but these hedge funds, these institutional investors are buying insurance contract, and they're paying it to us right now. It's not like they have less information than us. It's because of their motivation and the purpose of trying to protect the volatility, to reduce the volatility. That's why they purchase these instruments. And whereas we just come in and say, hey, if you want to give up money just to hedge your position, we're happy to take on the other side, because I know you own that stock. You don't think that stock will go down. Otherwise, you would just sell it. You're buying hedge because you want to avoid the short-term volatility, right? So does that kind of answer your question? It's not like we know more information. We already know the banks or these institutional investor wants to own these piece of asset. They're just buying insurance in case it dropped too fast. But then they still want to own it long term. So we're actually on the same page, if that makes sense.
Yep, that makes sense to me.
Cool. So now we own the property, or we own the stock we want to own at a cheaper price. Right now, we're going to introduce the next step, which is rent to own our stocks out. Okay, so some real estate investors already know this, some of the investor will be like, hey, landlord, I cannot qualify for a mortgage right now, but I'm willing to pay you extra cash flow, right? If it's the rent is 2,000, I'm willing to pay $2,500 every month for a chance that I can buy this house 5 years from now. And you can put in engineer in a 5% appreciation every year that we both agree on, but I'm willing to pay extra cash flow with the baked in agreed on appreciation, assuming that 5 years down the road, I can qualify and buy that house at that price, right? So same thing here. We are the property owner, we are the landlord, and now we are basically rent to own our stocks out to these tenants right now that are willing to buy it at a cheaper price, right? So what does that mean, right? When we rent to own our stocks out, we are like selling cover calls, right? Selling cover calls. Again, for people who doesn't know, next slides will be right there for the example. So stick around for this theory part first, right? So once we buy the off-market stocks, can we rent it out for cash flow, right? As a real estate investor, as a landlord, can we rent our place out, right, and agree to sell it to this tenant 5 years down the road if the price do get there, what if they do qualify? So that's the same thing we're doing. We're getting extra cash flow, agreeing to sell our stocks down the road. Might not be 5 years, but it might be 1 month, 2 months from now, if it goes higher than the price we bought it for, right? If it doesn't get there, we keep the cash flow, right? It's just like same in the rent to own, right? If tenant not qualify, unfortunately, hey, they do lose the chance, they don't get the extra cash flow back, right? They just keep moving on, right? So that's the same thing for us. So both sides, when we buy off-market stocks, we get extra cash flow. When we rent to own our stocks out, we get extra cash flow. Does that kind of make sense to you, Adam?
Yeah, for sure. And I've always been a huge fan of the rent to own strategy in real estate. Like, I think it's a really unique way to get greater returns with actually a very low risk. As long as you had the liquidity and as long as you had the patience to actually exercise the strategy, it's a fantastic strategy in real estate. So I totally understand the analogy you're making here and the comparison. And I'm grateful that there's a comparative strategy in the stock and option world, because I certainly wasn't aware of that.
Yeah, I'm totally happy to share more. And now we're gonna get into an example with some heavy numbers, but I'm gonna be sharing on my screen, right? So first I'm gonna share this picture, right? Unfortunately, I couldn't find my mouse here, but if you guys follow me along, there's only a picture in the middle, right on top, AAPL, that's Apple. That's the Apple's ticker. It's kind of like the symbol for Apple. On the top left corner, 115.09, that's the current Apple stock price. Some people might be laughing at me because this screenshot was taken 4 years ago, right? When Apple was 115, now it's kind of double the price, right? And then the next line, roll down, you guys will see November 13, 2020, right in the middle, right? So those are the expiration date. Those are the dates that an insurance company will agree on selling. How long is your insurance contract, right? Rent to own, how long is your rent to own contract? Those kind of stuff, right? So that's pretty much you need to know at this point, and I'll continue to introduce as we go on. Okay, so now, like I said, we're gonna go and buy off-market stocks first, right? So that's what we call selling put options. So the current Apple stock price is at 115.09. and I go, remember I said I want to buy an off-market deal, right? I go to Papa John. Papa John thinks it will drop more. So in this case, when Apple's at 115, I sold a put option. That means I agreed to buy this stock off market at the price of 108. Okay, at 108. So that's about 5 to 7% cheaper than 115, right? And what does that mean? So that means within 20 days, right? November 13, 2020, within 20 days, if the Apple stock price stay above 108, okay, stay above 108, that means, Papa John on the other hand, or the hedge fund institution investor on the other hand, cannot force me to buy Apple stocks. And in this case, is buy 100 shares of Apple stocks, right? So if 20 days from now is 108.1, 109, 115, 120, 200, I take away the premium I get paid, which is $227, and then I don't need to do anything. Okay, some of you guys might be, Cody, how do you come with $227? So you guys will see there's two lines, right? Right in the middle, there's a 108 that's highlighted blue, right? To the right of it, there's 2.27 and there's a 2.34. So there's a bid and there's an ask, right? A simple example is that bid is basically a seller if they want to sell it right away. They go to the bid. Ask price is a buyer if they want to buy it right away. They go to the ask, right? That's pretty much it. Right, so in this case, I'm the seller. If I want to sell this insurance contract right away, it's 2.27. And you're like, Cody, that's 100 times difference. Yes, because when we're playing off option contract, inherently, one option contract is controlling 100 shares of the stock. So in this case, it's 2.27 times by 100. Okay, that's why when we sell this put option for Apple stocks at 108, expire in 20 days, we receive $227, and this is USD. Is that clear as mud, Adam?
Yep, totally makes sense.
Okay, cool. So there's two scenarios, right? People ask me, Cody, what could happen? I'm like, well, the stock could go up, or stock could go down, or the stock could stay the same, right? So in this case, right now, Apple's at 115. So if it stays the same, it's still above 108, right? So let's look at the scenario where if the stock price stays above 108 in 20 days, what will happen, right? First thing, I'm the insurance company, right? When you pay for insurance, whether you make the claim or not, you never get back the premium. In this case, I'm the insurance company. So I keep your $227, right? From the hedge fund managers, from the institutional investor, or from Papa John, right? So I keep the $227 regardless. I don't need to buy 100 shares of Apple. Why? Because, it's not below 108, right? Then what do? I keep the $227 and I rinse and repeat, right? So just for people that are like, Cody, so what does this mean? What is the return then? If you use 108 times by the 100, right? If we buy 100 shares of Apple at 108, it's $10,800. If you use $227 divided by $10,800, right? 227 divided by 10800, that's about 2.1% in 20 days. Right? So if we divide it by 20 times it by 30, that's about 3.1% in the month. If I keep doing this, if I assume I can continue to do this and never have to buy Apple stocks, that's 3.1% every month. Okay? Is that clear for you, Adam?
Yeah. I guess I do have one question.
Yeah.
It might come up here at the end, but what was your how much capital did you have to stake in order to make
Yeah.
this
So
put option?
very good question. Very good question. It's like when you when when you try to take over off-market deals, you already have the down payment ready over there to close the property, right? Same thing here. So, and for us to sell put options on Apple agreeing to buy a 108 and 100 shares of them, I always want to keep 108 times by the 100, and that's USD. Always want to keep that on the side in case I need to buy Apple, right? Does that make sense to you?
Yeah, but is that so? I guess my actual question is, so that makes sense, right? Because at any point, like whatever happens to this individual stock, it could go from 115 down to like 107. That's
Mhm.
completely feasible, like in a news cycle or something happens. So, but what my actual question is, like, in order to put in this actual bid, like for this like deal to become legally binding, does that money need to sit anywhere? And the reason I ask this is because, like, so I did a lot with crypto, right? Matt and I had a show
Mm.
where we talked daily about cryptocurrency, and we
Staking.
use in cryptocurrency we use smart contracts, right? And
Hmm.
so in order to do a smart contract, that's where like the crypto itself is guaranteeing you have the money because it's actually locking up that currency for the period of the
Hmm.
smart contract, so that if, for
Right.
example, this stock went to 107, it would automatically trigger the transfer of the capital. But in order for that to happen, you would have to actually put up the money and freeze it for that contract's duration. So
Yep.
is that the case with this, or does this just sit in your account freely and you're just legally obligated to pay it should that trigger occur?
Yeah. A very good question, Adam. And remember, a lot of people think stock option is risky, is because these brokers that we're using to trade stocks, right? You use maybe, I don't know, Binance or Coinbase, different things that you could use, right? But in this case, we use Interactive Broker. I'm not sponsored by them in any case. You can use whatever you want, right? For me, when I say we need to have the cash over there to be able to sell put options, that is our own standard. That's the best standard. But are there people only have half the money with
Ah,
$5,000 trying to sell it? Yes, there is. That's why when COVID happened, these people were swimming naked. And the broker only required you to have 1/3 of what's required. So like, hey, if you have 1/3, you have $3,000, go for it. But is that the right practice? No, because if the market move, you might get margin call. If the market move, they'll call you and say, hey, can you put in another 7,000? No, we're closing a position. Right. And during COVID timing, brokers are trying to save their own butt, right? So they are being more careful. Say we want 50% instead of 30%. We want 50%, right? So that could change anytime, and that's why that's differentiating the people who actually know what they're doing and have experience for, or with the people just like Cody. Why don't I make 3 times the money just by putting in 1/3? That's kind of like using leverage right now, but we don't want to use leverage in this case because we want to be the last one standing, right? We just want to own Apple stock. We're happy making 3.1% if we can continue doing this every month. Worst case, we own Apple at a cheaper price, right? Apple has doubled since I took the screenshot, right? So that's our mentality. It's not about how much money we make. It's about preserving capital and diversifying into stock options. It's not like laughing at each other. I make 40, you make 30, so I'm better. No, but you got to look at the risks, right? And that has really
yeah.
showcased the real estate market over the last few years. The people who are over leveraged, they're
Yeah.
just belly up, right?
Well, and that this like strikes my, when I think about this, what immediately came to mind when I think about what's going on in the real estate industry by large is people will buy properties and like leverage them as far as possible, right? So you'll get a first mortgage and then
Yeah.
you'll go and get a second mortgage for all of the equity that you have in order to put down another down payment on a future investment or get renovation funds out for the next project, using all of your available equity from the first property. And what ends up happening is you get like a very high risk profile, which if it works out, you can obviously get greater returns. But if it doesn't work out, you can really damage your financial position quickly. So yeah, I just wanted to know if it was obligated to be stuck somewhere, but it sounds like it's not, right? You have
It's
like some
obligated
sort
for
of
us.
standard.
All
Yeah,
our clients understand, but can
yeah,
we hold a gun to someone's head? Maybe we should take the gun
yeah,
part.
yeah,
Can we force someone to follow it? No, we cannot. There's always going to be 1 to 2
yep,
cowboys out of 100 people that are just like, Cody, I think I'm smarter than you. Okay, well, I mean, I can't stop you, but this is what happened to me. So I just want you to
yep.
know, disclaimer, right? Not my fault if that happened. And we have seen it as well, even among our clients. So just full disclosure for that, right? No matter what we say, some people are just adrenaline junkie. You just always want to
Yeah.
make more money and to feel good about it, right? And unfortunately, that's, they won't be, they might have other ways of making money, but they will be losing money if they have those kind of mentality. Because if you always have water up to your neck, eventually you're going to get drowned, right? So
Yeah,
that's just not a
for
good
sure.
practice. Yeah. So back to this, we have scenario one. If the stock goes up, stays the same, will go down from 115, but still stay above 108, we are still okay, right? We got paid premium, we rinse and repeat. We don't need to do anything. Now, the next scenario might be most people are interested in. It's like, Cody, what if Apple dropped below 108? Something hit the fan. What will happen to you? Again, I still keep the $227 premium in USD. I still keep it. Now, like I promised, like when I sell the insurance contract, I agreed to buy 100 shares of Apple at 108 instead of 115.09. So even if the stock dropped below 108, I agreed to buy 100 shares of Apple at 108, which is already 7% cheaper. That's like buying off-market stocks, right? And because I can pay 2.27 per share and I own 100 share, my cost of ownership actually further reduced from 108 subtract by 2.27 to 105.73. So I just wait for 20 days. Instead of owning Apple at 115, now I own Apple 105.73. But if it doesn't drop, I just keep receiving my $227 or 3.1% if we can continue to run it like this. Is that clear for you, Adam, up until this
Yeah,
part?
yeah, that makes perfect sense.
Awesome. So now we finish introducing the buying off-market stock parks. And if you guys are a little bit confused, just run it back and run it a few times. Now we're going to go into rent-to-own strategy, which is one of Adam's favorite strategy in real estate, right? So now that we own Apple stocks, because it go below 108, for simplicity of the example, I say I'll keep Apple stock price stay at 108. Okay, that's just for simplicity example. It's already down 7%. Okay, now we're gonna go sell a call option. That means we take our stocks, we rent to own it out. Okay, and then again, we do the same contract. We do the same contract expire in 20 days. Okay, in this case, I want rent to own, get extra cash flow. In this case, I rent to own my 100 shares of the stock. I receive $510 in premium. You're like, Cody, what on earth are you talking about? So if you guys go, right, go on this middle of this chart here, right? 108, right? That highlighted green, 108 to the right of that, the bid was 2.27. Now, if you go down to the 115, right? Because right now, when I took that screenshot, the stock price was at 115. And at 115, the premium I'll get paid, right? On the call side, which is on the left side of it, is 510. Okay, it's 510. The put in call are the same, 510. That's why I say, hey, if the stock price is that price at 115, I assume I'll get paid 510. And it's very accurate. Maybe a few dollars off and all that. So 510. Okay. So because there's 100 shares, so I get $510 premium upfront. Adam, I just want to make sure I still have you. Is that
Yeah.
clear?
So I guess like, yes, reading the chart, I can see that there's a 115 highlighted in blue, and I can see the 510. I can also see the 525. But what actually is how are these both on the same chart, if you know what I mean? So like, we're down
Yeah.
several rows. How did that get onto the same chart? Just so I understand how the chart itself works.
Yeah. So, so 115 is the current stock price. When I go down to
Yes.
115, the exact same price, if I agree to own the stocks right at that price, I can pay more money, right? But if I go and
Okay.
agree to own Apples at 108, I can pay less money, but I can own it for $7 cheaper. That's kind of the idea of it. You know what I mean? The
Okay.
further you are from the current stock price, lower risk, lower chance you will own, but you can pay less, right? In this case, if it's
Okay.
right on the dot, it's like, yeah, so you can pay more money, right? So that's kind of like the idea for it.
Okay. Yep. I totally understand.
Okay, cool. Now again, there's two scenarios, right? Now that the Apple stock price is at 108, right? We agree to sell Apple at 108. If it goes above 108 in 20 days, we are gonna sell Apple stocks at 108. But if it stays below 108, we keep all the premium, right? So there's two scenarios again. If the stock price go above 108, or go below 108. And let's go right into above 108. What will happen? Like I said, regardless, we're going to keep the premium. In this case, is $510. I get to sell 100 shares of Apple stocks at 108, right? I own it on the left-hand side bottom. Cost of ownership is actually 105.73 for me, right? Even though I bought 100 shares of Apple at 108, because of the premium I receive up front, it offset my cost. So it's actually true ownership is 105.73. So I say, hey, I just agreed to sell Apple at 108. I'm okay with it, right? Receiving $510. So in this case, at this point, my cost of ownership of Apple is actually from 105.73 subtract by 5.10, and it's 163. Okay, so what does that mean? That means when this happened, I have to give away my Apple stocks. The profit I'm realizing is 108 subtract by 163, which is $7.73 difference, times it by 100 share, is $737 in 40 days, and that's USD. So just by doing that, 20 days, wait for 20 days to own it, Apple drop, 20 days later, kind of went above a little bit, I sold it, boom, just by transacting that, agreeing to own Apple at a cheaper price, agreeing to sell Apple at a higher price, boom, $737 in 40 days. Okay? Does that make sense,
Okay.
Adam?
So yeah, I think I'm following, but we just gotta go a little slower on this one for me because okay, so basically in the first scenario, we said we'll buy Apple at a discount if the price goes down. The price did go down to 108, and then
Mm-hmm.
can you just in like one sentence explain the call option to me? So you essentially bet that the price would go up. You already own the stock at a discount because of
Correct.
your premiums that you were paid, as well as
Correct.
the actual dip in the market, right? So you're down to 108, then you got a premium that you were paid, which further reduced the actual cost of ownership.
Mm-hmm.
Now, so now is the bet that the stock's going to go up, or is the bet that it's going to stay the same in order to get that premium for 510?
Very good question. The bet is I don't care. The bet is,
Okay.
hey, I'm owning Apple stocks at 105.73. I'm agreeing to give it away at 108. But if I don't give it away, I'm happy to hold on Apple stocks forever. I don't want it to get called away. But if Apple all of a sudden rebound and they have to take it away, fine, I'll just make $737 in 40 days. But if it stays below that, it's fine. I want to own Apple anyway, right? It's much better than buying Apple at 115 20 days ago or 40 days ago. Does that kind of make sense? You already bought an off-market deal. Now you're trying to rent to own it out. And you're like, hey, Adam, or hey, Cody, unfortunately, the tenant cannot qualify. But right now, the property price went up from $500,000 to $600,000 in 5 years. I'm like, well, too bad for the tenant. You know, you kind of promise it, but it's fine. It's fine, right? I still keep the property, 600K, right? But in this case, we kind of cap ourselves at 600K and say, hey, if the property price is over 600K, we have to sell it, right? But if it's below 600K, it's fine, right? We continue to get more cash flow. But if it's over it, we have to sell it in this case.
So
Does that kind of
what
make
is the
sense?
direct relationship between the 115 with the 510 premium and where we are right now at 108? I guess that's the part where I'm kind of stuck. Like, why wouldn't the
Mm,
premium be any of those other numbers between 108 and 115?
mm.
Or are we
Yeah,
assuming
so
that the stock is going to rebound right back to the previous current price of 115?
oh no, we're not assuming that. So very good question. What we're trying to do is when the stock was at 115, we look at right at 115, what's the option price? What is the premium we're going to get paid? So we assume when the stock is 108, that is the premium we're going to get paid because that's the current stock price. So we use that 115 premium because I'm supposed to take a 2 screenshot. But from our experience, it's a few dollars away, right? A few dollars away. When it's 115, you want to sell option 115, that's how much premium you're going to get paid. The further you get away, the lower risk you get, the less you're going to get paid. Does it kind of help you in this case?
Well, so I guess my actual question is like your original put option, right? I understand that bet. Like I understand if it goes to 108, we get paid 227 per share. I guess like my question is how if it doesn't matter how far above 108 it goes in order to get this premium, how come we use the premium that gets paid at the rate
Very good question.
of 510 at $115?
Very good question. If we look at the top right corner of this slide, right now, the current Apple stock price is 108, and we sold a 108 call option. It's like imagining when Apple stock's at 115, we go sell a 115 put option. If its stock is at 115, we go sell a 115 put option, how much are we going to get paid? 5.1, right? But if the current stock price is 108, we go sell a 108 option, how much are we going to get paid? Roughly 5.1 as well. Is that apple to apple now?
Yeah, that makes sense.
Yeah, I should have took 2 screenshots. So sorry about the confusion.
No, it's fine. I just want everyone at home too, because I know if I have the question, I know there's somebody watching right now who's like,
yeah,
what was that again?
I know. I present this to thousands of people and they follow me off the stage and be like, that number, how do you come up with that number? I have a lot of people following me for that. So that's good. Very good. Right. So now scenario number 2 is at the stock price, do continue to stay below 108. What will happen? Right? I still keep the $510 premium. Right? In this case, I get to hold on to my Apple stocks. It's like rent to own. If the price did not go to 600K, sorry, landlord continue to get to keep it. Same as us here, right? We hold on to our Apple stocks until it go above 108. If we continue to sell cover calls or call options or rent to own our stocks out. Okay, so in this case, our cost of ownership, we still receive the $510 premium. Our cost of ownership is 105.73, subtract by 5.1, now is $100.63. So what do we do now? We can rinse and repeat. We can continue to sell cover call at 108, but now our true cost of ownership is $163. Right? So what will happen? If we rinse and repeat enough times, we can own Apple stocks for free because every time we sell a call option, $5, okay, now my cost of ownership is 95. Sell another one, 90. Sell another one, 85. Eventually, I can own the stock for free. Does it kind of make sense?
Interesting. Yeah, no, it definitely makes sense in terms of if you keep rolling it back in, continue to make that bet with that premium kept. As long as you keep the premium and actually, retain that premium, I could see how you'd say it was technically free.
Right now is at $200, right? Apple. Then along those way, I can sell 108 call option, 120 call option, 130, 140, 150. Eventually, if I get caught, my difference between 150 and 80 was $70. It's $80 difference times by 100 is 8,000. I don't want to lose it, but if I have to lose it, okay, fine. I'll walk with $8,000 profit, USD, right? It's not too shabby, right? So before we move on to our said and done strategy back testing, is there any other question for this slide? I know this is a very busy slide.
Yeah, I mean, there's a lot going on in this slide for sure, but I think it generally makes sense, right? Like you're betting on the way down, you're betting while you're there as well, and you're essentially collecting insurance premiums in order to get cash flow. So I'm following. I'm with you.
Yeah, that's good. Okay, that's good. Thank you. Basically, we agreed to buy the stocks we want to own at a cheaper price. That's selling put option. That's buying off-market stocks. Now that we own it at a cheaper price, we agreed to sell it at a higher price. That's selling call options, as rent to own our stock sell, and both sides we receive premium. And eventually, we either own the stocks we want to own at a cheaper price, or we own the stocks we want to own for free. Eventually, okay. So now we're gonna move on. Now you're like, Cody, that is so good. Why is that not your said and done strategy? What I found over the years is that a lot of people think they're better than Warren Buffett, think they're good at picking stocks, right? Who knows, Apple would have doubled in the last 4 years. So for my own experience, a lot of times I pick 10 stocks, even if I'm really good, 9 of them goes up, one of them goes down, but that one that goes down, just say since 2021, one of that growth stock goes down, one of the, my Chinese stock that goes down, it dropped 90%. So all the gain from the other stock would drag down by this. Of course, we're going to talk about portfolio sizing and all that, but I can wash out a lot of my profits, right? Hence, over the years, I say, you know what, guys, if you guys want to spend time, you guys are not good at picking stocks, only base it on the S&P 500, right? So I'm sure, Adam, you heard about S&P 500, even as a real estate investor. Is that correct?
Yep.
Yeah. So we only use our sudden death strategy on the S&P 500. That took away all the individual stock risk, and that took away the high volatility of the Apple stock price goes up and down, or even Nvidia right now going up and down, right? So we only use S&P 500, and again, there's a little bit more advanced strategy I didn't explain here, but we run the testing for the last 10 years, from December 2013 to December 2023. Okay, and that strategy we'll use it as a strangle strategy. When we run the back testing, we run it as if we are the machine. So we use 4 management rules. We say, you know what, we're just going to sell this option for 45 days. We're going to hold it until expiration. We're not going to do anything. Or every time, if we make 25% of the profit, if we get paid $100, we can keep $25. We pay back $75. We call it a day. We exit, right? Or 50% or 75%. Not see how much money we're actually making, right? And we're being very dumb, like a machine. Like every time we close a position, we open it right away, and we do that for 10 years, from December 2023 December 2013 to December 2023, and see the results. Okay, does that kind of make sense for you, Adam?
Yep.
Okay, cool. Now, first thing is hold to expiration date. And I will explain a little bit more on the first slide, and everything else is the same, right? That green line is our backtesting set and done strategy. That gray line is the S&P 500. So Adam, if you're just looking at this chart, you tell me kind of what you see from 2013 to 2020, end of 2023. What do you kind of see in terms of the 2 lines? What are some important parts?
Yeah, I mean, like I would say that the backtest line generally follows the trend of the market. So like when the market's going up, it's generally going up. When the market's going down, it is tracking it down. But then obviously there's a gap there from, roughly 2020 into 2023 and beyond. It really starts to separate where you're building. The backtest is building against the stock.
Yeah. And most people will know that, and full disclaimer is that our strategy, our set and done strategy, works really well. Will outperform the market when the market is flat or slightly going down or slightly going up. But if the market is like going up, like 2024 has been going up like this, then our strategy could be on par or even lagging a little bit. So is the market going to go up like this every year? Probably not, right? Especially with all the volatility, right? So, our strategy there's no perfect strategy, but our strategy has been working really well in the long term. And you guys have seen it. There's a gap, right? In terms of ROI on the left-hand side, right? It's 300+%, whereas S&P is about 150%. If we hold to expiration, just like 45 days, close it, okay, repeat kind of thing. Okay. Now, if we do 25% profit target, right, you will see that, hey, it's kind of lagging a little bit from 2016 all the way up to 2023. Why is that? Imagine this is kind of like someone who is like taking the profit too early, right? Don't let the time do its thing. Taking the profit too early, right? So we actually, if we take 25% profit target, we'll be lagging the S&P 500. Okay. Now, if it's 50% profit target, again, if you guys are paying attention, I'll let you guys guess which one we actually use, right? This one of this 4. that we actually use, right? Back to this 50% profit target, we're kind of lagging between for a few years, but once the market starts going flat, we are outperforming again. Okay. Now, 75% profit target means that, hey, we can let the market swing, our position swing, but we only take profit after 75%. And worth noticing is that the 75% profit target, if you look at 2020 time, right? Adam, do you see a time where the back testing is dropping a lot?
Yep.
Actually going to almost negative? That is when
Yep.
COVID happened. So when market bounce really fast, our strategy will get hurt temporarily. And that's when we need to be, hold down, know what we're doing and all that stuff. Don't panic. But if you set a 75% profit target, it will have more volatility. But in the long term, you will see the line goes into 300% over the last 10 years as well. Right? Whereas the S&P 500 is a little bit above 100%. Okay. So hold to expiration, 25% profit target, 50% profit target, 75% profit target. Do you have some question, Adam? I know no one can vote with me now besides you, but can you guess which one? Do you have any question, or do you think which one is our team that's using?
Yeah, I mean, obviously you would want to go with the 75% profit target here. I guess like just to ask like an interesting question maybe for the audience here, and like just to have a bit of a debate here, like when you can somewhat predict big market shifts, are you going to pull out this capital or do you just let it ride? So like here, for example, right, 2024 federal election, right? It is going to be wild. Whatever happens is going to be wild. It doesn't, like, to me, it almost doesn't matter who gets elected or what happens, but something's going to happen that will cause massive uncertainty in the market. And so like, I'm going to say like, well, it's going to be a big swing one direction or another. So when that happens with this strategy, do you just sit and watch it happen, or do you pull all capital and just wait?
Do you ask such a good question? That is why my team of 6, it's always continue to improve our strategy. And we notice the same thing because we always look at in the past, what are the biggest drop? Can we withstand it? And all that good stuff. And we're clearly understanding the elections coming. A lot of volatility will come. So actually, one way of mitigating the risk is how much percentage of capital we're actually putting this strategy. So what's the capital employment? If you have $100,000, what percentage are actually using? When we think more volatility is coming, we use less. But that, at the same time, I hurt our returns as well. But what we're working on right now, soon we're actually going to release this. On top of our set and done strategy, we're not going to just use S&P 500. We're going to use some non-correlated ticker that either reverse correlation with the interest rate, or that's more not even correlated. It's a consumer staples. It's like all the Walmarts, all the Costco and all that. No matter what, people has money, no money, election, whatever, people need to buy food. So we have a different criteria, and we chop off our portfolio that way. So S&P, we know, has traditionally making the most amount of money, 8 to 10% per year. But hey, this year has gone up a lot, so we are shifting our money. So it's constantly in position, but we just shifting in between different things. If it's, hey, elections coming, we're going to shift it more towards consumer staples, more towards, we think the interest rate will drop, right? Then we're going to shift to that. Non-correlated things to the tech stock, because most of the S&P 500, 30% of them are the top 7 stocks, right? NVIDIA, Google, Apple, all that. But they've already gone up like 40% this year. So we got to be very careful. So very good question. Very good question. And then stay tuned for the future episode. That will come out very soon. Other than that, if you pick 75%, that's logically a good answer. But for us, since most of our clients are looking at preserving capital and lower volatility, we actually, I'll keep that until the end maybe, because I will show you guys, sorry, I gotta pull it back. I want to show you guys the stats here and then see if you change your mind and all that stuff. Okay. Sorry about that. I pulled it back. So this vertically, we're showing you guys, the no profit target, 25% profit target, 50% profit target, 75% profit target. What is the standard deviation? For people who, not so into math, the higher the standard deviation means the bigger the volatility in your stock price and your profit, right? So the bigger that is, the bigger the swings. Rate of return, ROC is rate of return. And you guys will know that, no profit target, 328% in the last 10 years, 25% profit target, 120%, 50% profit target, around 220. And like Adam said, 75% profit target has the highest rate of return on capital of 342%. In terms of win rate, they're all pretty high, between 86% to 98%, but 25% profit target has the highest win rate, but has the lowest return. So the market is actually kind of fair as well, right? So Adam, if we go look at this again, do you think you would still pick 75% profit target as your strategy? There's no right or wrong, just so you know. Whenever I let people vote on this, it's a total split. So now
Yeah, I
looking
mean,
at
I
this,
guess it really comes down to that first activity of your why, right? Like, what's your risk profile? How much do you need to win in order for this to make sense for you? So, like for me, I still like the 75% profit target, but I could see how a lot of people would reason that maybe the 50% would be a little bit less volatile and have great chances of winning without having a ton of risk. Um,
Mhm.
so, yeah, I mean, winning 95% of the time is pretty good.
Yeah, so yeah, that's you concluded for me. So 75% you have to have the stomach for it. Some of my clients have it, but more clients want the 50%. They're the doctors, they're the real estate investor, they want to see big swings. So they'd rather make a bit less. 220% over the last 10 years is like 20% per year. Still really good, right? And they have a high enough
It's
win
amazing.
rate. There's no right or wrong. Again, this is back testing on the strategy, right? Going in the future, we don't know. I hope I had the crystal ball, but I don't. That's why this is one of our ticker we're using. We're actually diversifying within our set and done strategy, and we can do less things, and we always can deploy our capital, right? We know we might make less money, but you never know, right? Texas was doing well. Texas might not be doing well. Then our other portfolio will be doing well. So we're diversifying within our set and done strategy as well. We have our first milestone of talking about our why. Now, this milestone is really helping you guys understand where you're at right now and where you could have go with our set and done strategy, right? So this is an easy step where you go through how much cash you have, GIC, ETF, mutual fund, TFSA, RSP, knows how much bullet you have, and what's the return you're getting, right? If you're already getting better return than mine, keep doing what you're doing. If you're happy with 5 to 7%, totally fine, keep doing what you're doing. But if not, something to think about. Again, how much of an unused line of credit? A lot of people have equity. They put home line of credit on it. Where personally, I have $400,000 of personal line of credit, unsecure, not secure, unsecure. I never really use it unless it's for short-term construction. Like balance transfer, give me 3% for a year. I'm like, well, might as well use it then, right? But I wouldn't want people to start using this line of credit when you're starting out. Even after experience, this is still leverage money, right? And people are making the spread. I still don't quite like this. I'd rather you use more cash, right? And also how much equity in your property. So you will know, you can't really eat the equity. So somehow if you want to, some people sell the property not making cash flow. Now they can put this equity into our set and done strategy. To me, equity and actually cash and all that, ETF, mutual funds, TFSA, RSP, easily could be deployable, but the line of credit will be further down the road once you get more experience, but still be very careful. Okay. And once you add up the 1 to 3 and then times by 36%, that's kind of how much you will be making per year. Right. So for me, I grew it from 500,000 to 1.6 last year, 1.6 million. Last year I make 36%. So, do an easy math, that's about 500,000, right? So, that is pretty good for me. I never seen that money when I was a kid. So it's pretty good for me, but it might not be enough for most people. Or might not be enough for some people. But half a million divided by 12 is 40K USD per month, right? You really need to do a lot of things to spend that money, right? Maybe you're Andrew Tate or something, flying private jet, right? Otherwise, a lot of people aim for 10K per month, and you could get there with my own track record of it, right? Can you make less? Can you make more? Yes, right? But this is totally based on my own track record. Okay, but that just gives you an idea. If you guys want to stop the video and calculate it out, how much can you actually make extra per year, right? To really go and tie in with your why, right? So now we know where you are, why is where you want to go, and now the set and done strategies help you how to get there. So this is the text setup, text structure setup. I'm from Canada, so if you're watching this in US, I have GPLP and LLC set up in US, but this is in Canada. Most of my stuff is still in Canada. So this is really for Canadians only. Okay, so let's say I pay myself $100,000 per year. That could be from my set and done strategy or from my full-time income. How much am I going to get taxed? If it's if it's an active income, maybe 30%, maybe, right, Adam? 30%?
Yeah, at
25,
least.
30%, right? Yeah, at least, right? Now, there's a better way of doing it, right? You will hear a lot of 6, 7, 8-figure entrepreneur are doing it smartly. Again, there's limited option in Canada, but this is what I've been doing. Okay, most of my clients are high income earners. They own their own practice, like dentists, doctors, business owner, accountant, lawyers, or just small business, right? Small to medium sized business. They have their own corporation. Okay, and some of them use our set and done strategy in the corporation. They put the money in there. If they make less than $500,000, at least in Ontario, it's about 10 to 12%. If you make net less than $500,000, right, you only pay 12.5%. Even after $500,000 is 24%. It's still a lot lower if you make $500,000 in your personal income, right? $100,000 paying 20, 30%. Once you go over like 140 to 200, your marginal tax rate is like 54%, right? It's much higher than 12.5 or 24%, right? So this is where
Yep.
a lot of my clients will put their set and done strategy in their active corporation. So they treat themselves as kind of day trading, but whereas they're not, because they're only spending 30 minutes per week, but they're doing a set and done strategy. They're offsetting, writing off stuff and all that good stuff. If they make less than $500,000, they pay 10 to 12%. More than $500,000, 24%, right? That could be your property management corporation, your professional corporation. Again, I'm not an accountant. It's just what I've seen that hundreds of my clients have seen how they set up, right? And this is how I set up my stuff, right? And then the next thing is that a lot of real estate investors already have the holding corp, right, Adam? I guess most people have holding corp if they're real estate investor, if they want
Yep.
to continue to scale, right? That's where your passive income is. You don't want to mix the two together, right? Active income, passive income, because passive income in Canada is 50% will be charged capital gain. So you want to separate it, right? But the key thing is you put your real estate holding corp. Again, I put my real estate holdings in my holding corp, right? I make money in my operating corporation and I pay least amount of tax and I shift it. I go buy property, use my operating corp to qualify. And I put my real estate property in the holding corp. And doing all this, right? You never heard me talk about paying myself. Yeah, maybe I pay myself 50K, pay myself 100K, right? But right now, going to the high net worth program, I don't really need to pay that much. Maybe 50K is good enough. I have enough to go against it, right? That's what the banks really want to look at. If your ratio is higher, it's just like, how much money do you have? Can you back it up, right? And most of my clients are in that stage. So they make money in their operating corporation, right? They go buy real estate, put it in the holding corp, and then pay minimum amount of tax in your operating corporation from their set and done strategy and operating income. They put it in the holding corp, and then they snowball. So not only they make money here, they never pay themselves personally to pay 54%. All of them is an operating corporation. They make money, they buy real estate, buy the real estate goes up, real estate cash flow, real estate refi, put it back in the operating corporation, make more money, buy more real estate goes up, refi, go back in the operating company. Adam, are you following me? That kind of snowball effect that going on,
Yeah,
and
absolutely.
we never pay ourselves, right? You pay ourselves what we really need, right? But a lot of things in business you can write off, right? So here we go. You only pay yourself when required, and the wealth snowballs in the corporation. So you make money operating corp, buy real estate, put in real estate holding corp, do your burr, do your flip, do whatever. Not do flip and operating corp, right? But appreciation, refinance, go back to operating corp, make more money, pay less tax. So you're not getting government reaching into your pocket and getting that extra marginal tax rate of from 20 to 54%, right? Always paying 24% or below. And that's how you can continue to grow your wealth and have less, paying less tax legally. Again, I'm not an accountant, okay? I'm just sharing what I'm doing, right? Does that make sense for you, Adam?
Yeah, I mean, there's a ton of dead weight when it comes to taxes. Like that's where a lot of real estate investors lose their capital is when you actually sell the building and lose it to capital gains. And that's why you see a lot of people on the channel going for the BRRRR strategy to attempt to refinance. But again, with rates being where they've been for the last little while and property values as well, it's been more and more difficult to get great BRRRR projects where you can actually refinance out enough capital at a good enough rate in order to reinvest and still have enough capital. And real estate's just so capital intensive to begin with that's where, that it becomes very tricky very quickly when you're just invested in real estate. So it's great to see that there's a similar structure here that you can benefit from in terms of you're basically burying these stocks, right? Like you keep bringing them in, taking your bets, taking your cash flow, and then buying
Yeah.
more with the proceeds. So
Yeah.
that's the
And then
repeat
get taxed
stage of the BRRRR, right?
less, right? Get taxed
Yeah,
less. And you don't have to deal with the contractors, the tenants, the toilets, and the ever
yeah,
hard Lennon tenant board in Ontario, especially. That's why people go to Alberta, go to
yeah,
US. But hey, grass is greener on the other side. I've seen different problems too. I was
yeah,
just in Atlanta, Texas, Florida, right? There's different problems. Different corporation. I cannot use 1031 exchange as Canadian, right? So
yeah,
there's grass is greener. So now I've come to the point where, you know what, I just want to have the lifestyle, less headaches, less is more. And I don't want to do so many things in life because I just cannot spend time on things I really want to spend time on. I'm just thinking I'm making more money, but am I making more money? Maybe not, right? So that's where I'm at. So I'll quickly go over why we're sharing this because some people might be asking, Cody, if you have a strategy that's working, why do you share with so many people? Why do you keep doing it? Go start a hedge fund, secretive raise 100 million, 1 billion would be the next BlackRock, right? So I'm the first generation immigrant. I was working 800 hours of overtime from the age of 23 to 29. I was working at Honda as an engineer, right? I was day trading at nights. Actually, if you guys follow me, my next YouTube video will come out. Share with you guys how day trading, I was unfortunately, the ones after 1 year actually making money, but I wish I wasn't making money. So I'll quit earlier because that really devastated my health, my relationship, and all that. I know, but I was trying to get ahead in life, right? A lot of my clients at a younger age might relate with me, but most of the clients cannot relate with me anymore because they have more than, a lot of times more than me, really, right? But really, what we're trying to do here is that we want to help more people achieve financial independence. That's what this channel, Canadian Real Estate Channel, is about. Real estate has been treating me really well, most people really well, but Canada's price has come to the point where the rent is not following up and has become so expensive to the point where we're not sure if the continue to print money will continue to solve the problem. If it solves the problem, can we actually refinance, like he said? How stable is this, right? So I'm constantly getting more people say they want to diversify, not everything in real estate, have 10, 20 properties. They just want to sell one or two, just diversify a little, right? So that's the people we're helping, right? And also we want less headache, more time. So because time is the ultimate commodity we cannot get back. It's not money. Money we can get it back, right? It's the time we cannot get back, right? So it's not just about the money. It's more about the lifestyle and the cash flow, right? And the reason why I share these pictures because when if you get some of you guys might know if you donate money to sick kids, donate enough, they will call you every month. And and I was just like using some of my influence to help the Mount Sinai Hospital to raise money for the mental illness because my someone in my close family member been dealing with depression since I was growing up has a big impact on me. I don't want people to have to go through that so they cannot make a decision. And also breast cancer, my mom has some, was removed, totally fine now, but Prince Margaret as well. So these are the cause that hold close to me. And now I have the time, a little bit of money that I contribute. The more I make as a corporation personally, the more I contribute. And it's really just more about go big to give big, right? That's the key of life. Okay. Some of the quick case study, right? Lessler, physician, anesthesiologist, same as my dad, age 45. Before he came to me 4 years ago, he's like, Cody, my only goal is to move to Hawaii with your strategy. He makes about multiple six figure. He's like, Cody, when I move to Hawaii, I need the money. I need to cut down my time so I can enjoy it. Right. So he successfully done that a year ago, moved his family to Hawaii. He achieved a 21% last year. He's like, Cody, I'm one of the one that's just average return. I'm like, Lester, who cares? You achieve your goal, moving yourself and your kids. He doesn't want to share your kids in the picture. So this is him taking a photo and one of the most famous sushi chef in Japan. All right, so he successfully done that. Also, another one is Jeff. Jeff is one of our oldest clients. We have 6 clients in their 70s, right? So, Jeff was actually sitting in a wheelchair. He used to be a commercial pilot. He retired forcefully 35 years ago because he got into a ski accident. So his torso down is all paralyzed. And he has a medical expense of $12,000 per month. He wants to create a foundation to fly challenge kids. He did a few times, but he's like, Cody, my pressure's too high because I have to sustain my medical costs and run this foundation. And then, at first I was quite worried if he could do it, but he can swipe right. His brain is really clear. And, after about 6 months, now he's spending 30 minutes per week achieving that, right? So if you're someone like Jeff, someone like Lessler, then, something you can consider about said and done strategy. Quick recap. You guys know about Cody Yeh. I was a guest speaker for TD Bank a few times. You know your true reason. You learn about buying off-market stocks, rent to own your stocks out. And you look at our said and done strategy 10-year back testing. Only look in the past. No one's the crystal ball, but that's your track record. My corporation structure, like I promised you guys, so you guys can keep more, continue to snowball your wealth, right? And why we're sharing this, so that you can, so that as real estate investor, you can make an additional $4,500 per month, and eventually, after a few months, spend less than 30 minutes per week maintaining it. Okay. And so, now's the time to kind of come to the next step, right? I do have a Facebook group. So if you guys want to learn more, you guys can, go to the link in the description here. Or if you guys are following me on Facebook or Instagram, right? It's Cody Yeh, Cody, last name Yeh. You guys can DM me CRES, and I'll personally guide you, or my team will guide you through our recorded training. Because in our Facebook group, I run Facebook Live. Holy cow, 3 years in a row, every week. I took a few breaks, but I ran it every week, right? And now I'm doing once every 2 weeks, right? So there's a lot of content and a lot of context. So message us, DM us, and we'll guide you through it.
That's awesome. Well, Cody, thank you so much again for coming on the channel. I really appreciate it. It was really fun to learn about what it is that you do, because it's not something that I spend any time at all thinking about. And it looks like that's probably an issue, right? It seems like there's great returns. There's great safety nets built into it where you can essentially continue to win and get cash flow while actually mitigating your risk quite a bit. I like that about both of the strategies that you showed today. The set and done strategy seems to be a really advantageous way to actually be trading without having to do a whole lot of work, which is great. And those returns are obviously fantastic, up and around 30%. That's like completely insane. So I really appreciate you sharing that today. This is another fireside chat with Cody Yeh. Like you said, the link's in the description. So if you guys want to go join his Facebook group or jump on that webinar for a lot more information, I'm sure they're going to get way deeper into the actual stock talk on that. So I appreciate the undertone here of financial independence and retiring early. I think that's very important. And it's never too late to set your goals up and set yourself up for success. So thanks for watching. If you made it this far, leave some kind of comment indicating that you're still here an hour and a half later and that you are seriously committed to financial independence. And I'll reach out to you personally and we can have a chat, because I think it's great that you're investing in yourself and being here on YouTube, spending a movie's worth of time with us to improve your financial position. So thank you so much. And Cody, we'll see you back here again soon.
Okay, thanks for having me, and see you guys all soon.